Okay, hi everyone. This is going to be the first video for chapter 11 here. Let me get that out of the road. Really, what are we looking at in this chapter? Utilization and disposition of our assets, right? Our long-term assets, whether that's our PP&E and intangibles. We're going to be looking at things like depreciation, amortization, and depletion. Okay. So it says here, right, PP&E and intangible assets are purchased with the expectation that they will provide future benefits, right? The assets are acquired to be part of the revenue generating operations, and the cost, therefore, should be allocated to the periods benefited by their use. That's a mouthful. What are they saying here? Hey, we buy a building, right? You don't expense that up front, right? Right. This would be wrong if you did like debit expense, right? Now you don't do that, right? You do debit building. And then, I don't know, say this building's going to last 10 years, right? So there's a 10-year period. Every year, right, you're going to take depreciation expense, right? Debit depreciation expense. The idea with this is, right, in theory, over that 10-year period, right, that building is going to help us generate revenue, right, as part of our business. So we're trying to match, right, the expenses with the revenue. This idea, right, of depreciation, it's called cost allocation, or alternatively, it's known as a cost recovery mechanism. In other words, yeah, we have the building on there, and to recover our cost, we'll take it through an expense, namely depreciation. Now, if you're dealing with kind of like fixed assets, PP&E, that cost recovery mechanism is depreciation. For natural resources, it's depletion. And for intangible assets, it's amortization. And there's different ways to calculate this, kind of different methods and frameworks. But at a high level, right, what I want you to just start with is, no, you don't immediately expense it, right? We talked about in chapter 11, basically for all three of these things, up until you flip the on switch, all of those costs to kind of ready and get the asset for use are capitalized, that is put on the balance sheet. And then theoretically, we're trying to match the cost recovery mechanism, namely depreciation, depletion, or amortization, over the useful life. Okay. So this is just kind of showing you here an example with a truck, right? So essentially, right, they buy it for 82. They think that it's going to last for 5 years and that they can sell it for 22 on there. So, right, like 82 in the back end, they sell it for 22. That difference, the $60,000, right, that's what we're going to take as an expense, right? We'll spread it out over the useful life. In other words, we don't expense this truck up front when we buy it. Instead, we match it over the useful life. Right now, whenever if we're talking about depreciation, right, it's kind of like having like a recipe, right? Like if it's like you want to bake a cake or something. Step one, whenever you open up a cookbook, right, the recipe always says like, hey, you got to gather your ingredients, right? So we need to know, right, like the service life, the allocation base, the allocation method. There's like a variety of things that we have to be aware of and kind of pluck out which ones are relevant for calculating depreciation. A lot of this, I'll be honest, is just plug and chug. And a lot of it, I can't really hide the ball in the sense like, if we're talking about useful life, I don't expect you, to have a crystal ball and see, oh, company buys a truck. I'm going to just project that it's going to last, 10 years. No, I would tell you, right? So, I'm more aware that step one is going to be gather your materials. And a lot of those materials I'm going to give you in a question or a homework problem. You just need to kind of pluck them out. So what are these things, right? We have the service life. So this is the estimated use that the company expects to receive from the asset. The allocation based, right? So this is going to be the cost of the asset expected to be consumed during the life. And then the allocation method, right? The pattern, how we're going to spread it out. So let's kind of talk about some of these, right? The service life, so the amount of use the company expects to obtain from an asset before its disposal. It can be expressed in units of time, right? We expect this truck to last 10 years, 5 years, or in units of activity, right? We expect this truck that it can drive, 100,000 miles. It can drive 200,000 miles, right? That would be kind of, as it were, its useful life on there. Now, one of the things, right, be aware that physical life is different than useful life, right? Like physical life is like physically how long will this truck be here? Um, but useful life is like how long will it be useful to us in our business, right? And that again, that will be kind of given to you on the exam. And this is just saying, hey, the useful life is different than the physical life, right? There's various reasons for this. Maybe there's technological change. Hey, maybe we buy a computer. This computer physically could last, 10 years. But if you ever buy a computer, right, the functionality of it might be like 3 or 4 years before that thing's like outdated, right? It's not really sort of running at the speed or has the appropriate technology for what we need in the business. Kind of similar thing with intangible life, right? You can have the legal or contractual life. That would be kind of like the max there for the service life. Maybe a patent lasts 20 years, right? Like in theory, just like the computer could last 10. But hey, maybe in reality, this patent, the market conditions are such it's really only going to be good for 4 years before maybe there's some better drug out there on it. Again, they're just kind of giving you some of the theory here. On the exam, I'm not going to be playing hide the ball on this stuff. I'm going to give you the useful life. The allocation base, right? This is kind of like the substantive thing that we're depreciating. How much do we depreciate? Well, essentially, right, it's going to be the initial value of the asset, right? So we're going to just put cost here, right, minus any residual value. As a general rule, right, that's the amount we're going to be depreciating. Now, it's different for different frameworks for depreciation. We'll see kind of how you calculate this. But as a general rule, the cost, namely all of those costs up until we flip the on switch, minus the residual value or salvage value. What's that mean? Well, hey, we have this truck on the back end. We might be able to scrap this thing for like $500 or something, right? Like just the raw material from it. And then the allocation method, right? There's different things for kind of each one of these, but they're either going to be based on time or some type of activity-based method. So time, right? If it's like a 5-year truck, 1 year passes, well then we got to calculate depreciation for 1 year. If it's a truck, and instead of using a useful life of years, we use miles, right? Like this truck's going to last 100,000 miles. Well, the activity-based method would look at our actual usage. In other words, in the current year, maybe we drove 30,000 miles. So we're going to have to account for kind of that proportionate actual pro rata, the amount we actually used in there. So that would be activity based. To the extent we use it, there's the activity, we would have the depreciation on it. So we talked there a little bit like, theoretically about the different cost recovery mechanisms, the frameworks. Let's start jumping into this for it. So we're going to start with depreciation. So we're talking about tangible assets, traditionally PP&E, right? We're going to have 3 different methods here, 3 different types of overall frameworks, right? There's straight line, there's accelerated, and then there's units of production. The first 2 are based on time. The third is based on, an activity basage. So with straight line, right, if you were to map it on a graph, it's like literally a straight line, right? So if we have, $100,000 building, right, that's going to last 10 years, right, we're going to take 10 per year, right? It's literally a straight line if you were to map it. Now, the actual calculation, we'll see a depreciation schedule on it, but I'm just telling you the theory here. With the accelerated depreciation methods, we have declining balance and then sum of the year's digits. Theoretically, right, if we were to put this on a graph, it's going to look something like that. And what we mean here is in the earlier years, right, there's going to be more depreciation, and in the later years, smaller depreciation. So I don't know, maybe we take like 90 in year 1, we take 80 in year 2, and then by the time we get to like year 4 or 5, it's at like 20 and 10, okay, on it. We will look at those. Units of production, it depends, right? I'd have to see how many miles did you actually drive the truck. It could be anything, right? Like a wavy line, it could be that, it could be this. It really depends on the actual usage on it. So it's hard to draw that in a vacuum, what it would look like, okay? So let's run through these, right? We're looking at depreciation. The first method is straight line. Right, we're going to look at sort of a traditional example here. We have a manufacturing company. They buy a machine for $250. The residual value is $40,000. 5-year useful life, estimated production 140,000 units. Right, so how we figure out the depreciation on this is going to be cost. All right, 250 minus residual value, 40, over 5-year useful life, right? So we're looking at $42,000 a year over 5 years, right? So if we were to run the depreciation schedule on this, right, this is just the schedule. You could map this out in Excel and kind of run it that way, but essentially we start with the depreciable base, right, which is going to be the 210, right? It's basically this guy right here, right? Cost minus residual value, 210 times 1/5, 42,000. Accumulated depreciation is 42. Book value for the year, right? We're going to start with, in this case, 250, which is the cost, minus accumulated depreciation of 42. Hey, we're at 208. Okay. Let's go to year 2, right? I'm not going to do the whole thing, but I'm just showing you here. One thing I want to call your attention to, the depreciable base is the same throughout. Run through, we're at 42, right? 42, the same for all these guys. What's changing here is, right, our accumulated depreciation, if we were to track this, right, it's like snowfall when it accumulates, right? You have 1 inch of snow, 2 inches of snow. Right here, our beginning accumulated depreciation was 42 from last year. This year, we added another 42 to it. Now we're at 84, right? If we were to do, in this case, right, the cost 250 minus 84, we're at $1.66, right? In year 3, we're going to add another layer onto it, right? Now we're at 126. If we do the cost minus 126, that gets us 124, right? So it just runs its way through there. You know, all of these columns are the same. The difference, right, comes in these 2 columns, right? It's different year over year. That's going to be traditionally the same for all of them. The accumulated depreciation and book value is different. How we do that journal entry each year: debit depreciation expense, credit accumulated depreciation. All right, let's look at double declining balance, right? In theory, right, this is going to look like this. We're going to have more depreciation in the earlier years, right, like 100 grand, and then as time passes, right, by the end we're at 14 grand. It is not even Steven on here. Likewise, right, this is not the same here. This is a different schedule. It's not, you know, one schedule for everything, right? How you run this, how you calculate it is different for each type of method here. So for double declining balance, what we do is, right, we're going to start with the book value as of the beginning of the year, right? So here, you know, in the beginning, right, it's at 250. Then essentially what we do is 1 divided by 5, right? There's 5 years, there's 20%. And because it's double declining balance, we're going to multiply that by 2, 40%, right? So 250 times 40 equals 100. Hey, that's, you know, going to now be our accumulated depreciation. Our book value at the end of the year is going to be the 250 minus the accumulated depreciation gives you 150. Carry that down, right? This is different right here from the last one, right? You got to carry that down. In the last example, right over here, this was the same. You didn't have any of that carry down. Here, you got to carry it down. 150 times 40, 60, 160, 90, carry it down, right? You kind of, keep running this schedule. It looks overwhelming, right? You're like, oh my gosh, there's 5 lines. If you take it just as one line and you're like, okay, did 1 line, rinse and repeat, do 2 lines, rinse and repeat, do the 3rd line. It's just a little formula over and over and over again. One thing you got to be aware of here is whenever you calculate this, you ultimately have to land at $210,000, right? Whatever method you pick, right, your total depreciation, that base has got to be 210, right? That's the same for all of them. In other words, what we're saying here is that's basically the depreciable base, right? The 250 minus the 40, right? The cost minus the residual value. That's all you have to depreciate. So whenever you're running this schedule, line 1, line 2, line 3, if you calculated line 4, right, I'm going to put a little asterisk there in the sense that if you ran the numbers on this with 40%, like it says down here, that would end up making your total depreciation exceed that $210,000 base. In other words, if it says down here, further notice that in year 4 we did not multiply it by 40%. If we had done that, it would have been 21.6, the depreciation expense right there. This amount would have resulted in an accumulation by the end of year 4 of 217 and the book value of 32.4, which is below the asset's residual value of $40,000. Right. So in other words, another thing you could say is, hey, we ultimately have to land at 40 at the end because that's the residual value at the end on there. So essentially here what's happened is we calculated it. If we ran the numbers on it, right, it would have put us below 40. Can't do that, right? So here what you do is when that happens, right, the little asterisk, you got to just plug it. Right. What I mean by plug is put the number in here that forces it. It's like force calcing it, overriding it. That gets it to where it needs to be, the $40,000 or the 210 there. Right. So again, this is different. You got to know the schedule. We'll look at problems, but it's not every schedule is the same. Next here is sum of the year's digits, SYD. Right, so what's going on here is, as it says down here, the sum of the year's digit method multiplies the depreciable base, right? So this is good, right? That's going to be the same in the sense we're looking at 210 all the way through by a declining fraction. So 5, 4, 3, 2, 1. What we do here is, right, it's a 5-year asset, and then we got to use this little equation, right? So n times n plus 1 over 2, right? So here n, the number of years, 5, we plug it in, right? We see that's how we get the 15. Right, so same, different based on this fraction, right? We multiply it by a declining fraction, run our way through on that, 70,000, right? We're looking at 180, year 2, 56, 126, 124. Again, that kind of same setup, the relationship there, we ultimately have to land at 40 on there. We ultimately only have 210 of a depreciable base. That's great. So sum of the year's digits, what's the new part? Where can you get tripped up? Probably this column right here. All right, just a little fraction. You need to know that guy right there to be able to do it. Okay, there's a MCQ you can look at. How about activity-based depreciation method? So again, here we're kind of, right, like I told you, how do we draw this? Well, I said it depends, right? I mean, are they using it a lot? Or, I mean, it could be anything. It depends on how much they use of it. So here they buy a machine for $250,000 and they estimate when they buy it that, hey, it's going to have a residual value of 40. It's going to last 5 years. And the main thing here is we estimate that this machine's going to pump out 140,000 units, right? Like maybe we buy a KitchenAid mixer or something to make like muffins, right? We buy this mixer, you know the KitchenAid mixers, they're like super expensive. We estimate that we can make 140,000 muffins with this, right? Then we look at, right, that's an estimate. We look at actual production. Well, hey, in year one, we made 20,000 muffins, 32, 44, 28, 26. Ultimately, right, we kind of underestimated in the sense we thought it was going to make 140, but at the end, it truly made 150. How do we depreciate this KitchenAid mixer, right, under an activity-based method? Okay, so what we're going to do here is we got to figure out the depreciation per unit, right? So it's 250 the cost minus the residual value, right? So we're going to use cost minus residual value over we think it's going to make 140,000 muffins, right? That's given us $1.50 per muffin this thing costs us, right? That's where we get this $1.50. Then what we do is we take actual, right? So you can see this is different from each year, right? 20, 32, 44, right? Because it's based on actual, right? If we go back here, right, in year one, we actually made 20,000 units, right? So actually we did 20, 32, 44, 28, 26. Cross multiply, right? Run the numbers, 220, year two. Again, one of the things you got to be aware of here, I'm just going to put a little asterisk. Hey, we ultimately did 150, but our estimate was 140. So that's going to cause a little bit of a headache here in year five, right? Whenever we calculate it, it would take us below 40. It would exceed 210 in depreciation. You can't have that. So in year five, whenever that event happens, right? So kind of your anchor here is, hey, it has to end at 40. If anything causes it to go below 40, then we're going to need to plug it, right? So I'm going to put plug, or you could think like force calc. I just kind of like manually override it to get it to where it needs to be, okay? So again, regardless of the method, right, the base is 210, right? What's different here is how much you take each year, right? Straight line is a straight line, 42,000. Double declining balance, right? We're taking more up front, less later on. Similar with some of year's digits, right? More 70 up front, 14 by the end. Units of production, right? It's like, well, we're at 30, then we go up to 48, then we go up to 66, then we go up to 42, then we go 24, right? It depends on what we actually used there. This is just showing you companies that use these different methods. Next, we're going to talk a little bit about theory, right? Which one should you pick? Well, straight line is the most commonly picked. And the reason for this is it's easy, right? It's pretty straightforward, on there. It says straight line method results in less depreciation in earlier years compared to accelerated depreciation, right? Because we're kind of just plugging along straight line versus up here, right? The accelerated methods, we're going to have more than straight line, right? That's a bigger up arrow. So you can see the effects of that on there, right? So here's some, reasons you would pick double declining balance. Here's some reasons you would pick straight line. And then activity-based depreciation, that's actually going to be the most accurate, right? Whenever we do that one where it's like, it depends on the usage, because it's really reflecting and truly reflecting how much you use that thing. Do be aware, and you'll learn more about this in your tax classes, how you calculate depreciation in these methods for financial accounting. Whenever you go to do your tax return, you're going to use different methods. So there's going to be a difference between how you calculate depreciation on your tax return versus how you calculate it on your books and records here in this class. Don't worry about IFRS stuff. Let's talk a little bit about additional issues with like partial period depreciation. So it says here when acquisition and or disposal occurs at times other than the beginning or end of the year, right, we're going to have partial period depreciation, right? So, hey, we buy an asset right here, we're only going to depreciate it maybe 3/4 of the year. We buy an asset over here, we might only depreciate it 1/4 of the year. It might not be a clean fraction, right? It might be like 1 out of 365, 20 days out of 365. All of this, right, if you're putting a bunch of assets in service during the year and you got to like manually calc the number of days for each of them, right, that's a headache. It's a lot of work, right? So what they come in is they make this fiction. And they basically say, look, we're going to use a convention, and you can pick, the convention you want. There's different things. Traditionally, you're going to see half year, but the half year convention says this, right? It's where 1/2 of a full year's depreciation is recorded in the year of acquisition when you buy it, and another half in the year of disposal. So it basically says, hey, we know you put all of these in up front. Each of them, we're going to treat it as if, right, a fiction, right, even though you bought it here, we're going to treat it like you put it in the middle of the year. We're going to treat it like you put it in the middle of the year on it. So we will give you 1/2 of a year of depreciation up front, make it simple instead of calculating all that as days, having the headache. And then in the last year, when you own it, right, regardless of whether you sell it or it's the end of the year, we're going to give you a half year then, right? So this kind of combination up front of a half year when you first buy it, and on the back end, a half year is going to satisfy, the amount of years it was in use on here. So they have an example. They're showing us some information on April 1st, 2024. They bought that machine for $250. Similar fact set. They have the actual production. They go through here with straight line, declining balance, units of production. We saw all this stuff, good stuff. And then one of the things, right, that they then talk about is it says the illustration shows how Hover, the company, would depreciate the machinery by these three methods, assuming an April 1st acquisition day. So what they're saying here is, hey, you buy it on April 1st for 1, right? You think about it, you're only supposed to depreciate that over 3/4 of a year. Back here, you didn't own it yet. So what we got to do is up front, right, in year 1, right, if we were to truly be accurate in this, right, you should only get 3/4 of the depreciation on it. Then in the final year, right, you'll get 1/4 on it, at least under straight line on there, because under declining balance, we're just going to plug it on there. Units of production, this is less relevant in the sense like we're not basing it on time, right? Over here, we're looking at time. Units of production, we're basing it on activity. So we can just use, the actual. We don't have to do any of this kind of prorated stuff. But if you think about it, right? So if the fact said it was like a 5-year asset, we got 1, 2, 3, 4, 5, 6. Like, what's going on here, right? Why do we have 6 years when it's a 5-year asset? Well, half of it, or 3/4 of it, you get up front. 1/4 you get on the back end. So yeah, that effectively only counts as 1 year. So it's like 1, 2, 3, 4, 5. Okay. Dispositions, right? Okay, so we bought the asset, we're kind of moving along, we're depreciating it, and then right, we sell the asset before the end of its useful life. Essentially, we got to take it off the books and recognize any gain or loss, right? So you would do like debit, cash, whatever you sell it for. That's kind of the first thing, what you get. Then you got to get it off the books, right? So you're going to do debit, accumulated depreciation, credit the fixed asset, right? You got to get that off the books. And whatever the difference is, right, you're going to have a loss, debit loss, or credit gain in there. Let's look at an example here. On here, so it says on January 1st, 2024, right, same facts set here. They They didn't hold it for 5 years, but instead they sell it 3 years later. So we got a 5-year asset, but 3 years in, they sell it on here. One of the things we got to do is, right, we got to make sure that whenever we do this journal entry, right, if we go back here, right, that this accumulated depreciation is up to date, right, all the way up to the date of sale on there. So in this case, right, what we got to do is make sure, right, that if it's, right there, we got to record the depreciation to get it to where it needs to be up until the X, the point of sale. So we got to do, the depreciation there for 2026. Okay, that's ultimately going to land us at 126 of accumulated depreciation. Right, so if we were to do the journal entry on this, you can look at it like up there, or you can think about the journal entry. Step 1, right, what did we get? Right, we got cash of 140. That's great. Step 2, we got to get it off the books and records. Right, well, we got to get the equipment off there, and we got to get the accumulated depreciation off there. Step 3, right, we got to plug the difference, right? Well, we got 140 and 126, 250 to make this work, right? We're going to have a gain, right, that we got to plug on there. Okay, that's great. They then have, a variation of it. There's either a different sales price or something going on here, but this is just saying, hey, whenever you do step 3, be aware it could be a loss as well. So you can look at those numbers. Just be aware that could be a loss as well. You can read that slide there on it. A couple other things, right? Assets held for sale. One of the things here is an asset is classified as held for sale in the period in which all the following criteria are met, right? 1 through 6. Essentially, what's going on here is it says here, sometimes management plans to sell PP&E or an intangible, but that sale hasn't yet happened. So we're holding it out for sale. It's like, hey, everyone, I'm trying to sell this. Here would be kind of the situation. In that case, whenever you have an asset held for sale, right, you have to report it at the lower of its net book value, or basically its fair value minus any selling costs, right? So I don't know, maybe it was at 100, its fair value is 90, right? The selling cost would be 10, right? That's 80. The lower of the two is 80. That's what you need to put it on there for, right? So we're going to have to write that asset down, that held for sale asset down by 20 to get it where it needs to be. Another thing you could do with an asset, right, instead of like selling it, is you could just retire the asset, right? It's kind of, we're done with it, we're done using it, you could abandon it. In this case, right, if you're going to retire it, the asset account and the corresponding accumulated depreciation are removed from the books, right? So maybe we are going to do debit accumulated depreciation of, I don't know, $70, credit fixed asset of 100, a loss equal to the remaining book value, debit loss of 30, right? That's how you would do a retirement on there. Again, you just got to get this guy off the books. It's not your fixed asset anymore. You're retiring it. Group and composite depreciation. So this is just saying that it can be a headache if you have like hundreds or thousands of assets to individually depreciate each one. So we may make a group of assets, right? So like A, B, and C, we're going to throw that into a group and kind of depreciate it as a single item there under group depreciation. Composite depreciation is similar. It's still a collection of depreciable assets. The difference here is they're going to be physically dissimilar. So this might be like machine A, B, and C, whereas this might be like we have a truck, right? We have a machine, and we have some other piece of equipment, right? They're physically dissimilar to each other. Again, we're doing a lot of this just for like convenience. It makes it easier than individually depreciating each one, right? So they have, an example here. They just kind of run through it. You can see how they kind of do this and read through on there for that group depreciation, right? You can read through that as well. One of the things is whenever you have that group, right? If you were to have like, a truck in there, right? You have like your truck, your machine, I don't know, your other kind of piece of equipment, right? If you were depreciating that as a group and then, in that way, right? Over that time period, you were to sell just like one item of the group, right? You're basically going to do, debit cash, and then, as it has down here, you're not going to have a gain or loss. So it says because depreciation records are not kept on an individual basis, we're doing it by the group. Dispositions are recorded under the assumption that the book value of the disposed item, right? So this guy right here, the book value, $3,000, equals any proceeds, what we sell it for, 3, and therefore there's no gain or loss. Okay? You can see a disclosure note. Don't worry about IFRS. Let's talk a little bit about depletion, right? So depletion is going to be activity based. And the idea with this is if you think about depletion, right, it's natural resources. So maybe you buy a Christmas tree farm, right? I don't know. I'm not very good at drawing Christmas trees on there. The idea with this is just like when you buy a building, you do not immediately expense it, right? You do not immediately expense that Christmas tree farm. And instead, what you do here is you say, hey, we're going to try to match the expense, right, depletion expense, with the useful life of this. And specifically what we say is to the extent we kind of rip out the trees, right, in year 1, maybe we ripped out 2 trees. In year 2, we ripped out 3 trees, right, like actual, just like whenever we talked about like the miles you drive your car, like the estimate versus the actual, that similar framework we're going to do here with depletion, right? So what we do here is we're going to have to figure out our depletion base, which is essentially our cost, what we paid for that thing minus any residual value. That will then get us our depletion per unit, right? We take the base divided by the estimated extractable units, right? Maybe we think we're going to get 100 Christmas trees from this farm, right? That would be the journal entry, debit depletion, credit, natural resource. Let's look at a number here on this, right? Give it some numbers with an example. Looks like they bought land. They had all of these costs for looking for oil and gas, right? That's kind of our, our going to be our depletion base in this case, right? It's going to be payment, actual, intangible, restoration, right? That's our base. If we go back here, right, cost minus residual value on this. Then it looks like, hey, we estimate, right, that we're going to get, let's see here, after blah, 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 300,000 was for it. Oh, 1 million tons. Okay. Right, so we had 1 million there of total, right? So we'll take essentially our cost minus the residual value, no residual value over the million total. We're looking at 276 per ton, right? So like, there we go. It's like there's the natural resource. In year 1, right, we ripped out 300,000 tons, right? So that comes from, right here, right, 2024. So we'll take the 276 times the 300,000. There's our depletion expense for the year, right? It's not that much different if you think about it from like the truck where you estimate the miles, right? Like we estimate in total 100,000 miles, and we actually drove 15,000 miles, right? It's a function of usage. It's activity based on there. Couple kind of nuances here, right? So if you have equipment used in extraction, right? So maybe you buy, like a bulldozer or something, right? How does that work? Well, if the asset is movable and usable in future projects, right, you can drive this thing out of there. You can use it on other sites and other capacities, right? The depreciable base should be allocated over its useful life, so however long we think that bulldozer is going to last. However, if the asset is not movable, right, maybe we buy some like, drilling, mechanism, right, where they're going into the ground and we can't move this thing, then we're going to depreciate it over its useful life or the life of the natural resource, whatever is shorter. Okay, so it says here the units of production method often is used to determine the depreciation on assets used in the extraction of natural resources. So in these cases, these kind of assets that we use to help us get the natural resources, typically we're going to use some type of activity-based depreciation. So here's a good example, giving you some numbers on it, right? We have that same fact set on there, but now it says, hey, in addition, we bought some excavation equipment for 600 grand, right? We think that it's going to have a residual value of 60, right? So we'll do cost minus residual value. We think we're going to get 1,000,000 tons from this mine, right? So it's 54 cents a ton. Hey, in year one, we ripped out 300,000 tons. Hey, there's our depreciation on that equipment, that excavation equipment on there. Again, don't worry about IFRS. Finally, here we're going to move to a little bit with intangibles and software development costs. With this, so intangibles, right, the useful life, it says legal, regulatory, or contractual visions often limit the useful life. Sometimes it might be less than the legal life. So it says, hey, right, a patent, the legal life could be 20 years, but maybe that's only really good, like the true useful life that we estimate for like 5 years before, it's not, as good anymore. It's, maybe there's another competitor, it's not really useful to us. Residual value typically is going to be 0, right? And then allocation method, what's the upshot of all of this, right? The sort of inputs would be given to you. When we're talking about amortization, typically this is going to be straight line, okay? So looks like we have an example here, right? They bought a franchise, right? So there was a franchise agreement they paid $200,000 for 10 years, right? Here's year one, right? 200,000 divided by 10, 20,000, 20,000. Journal entry. Hey, they bought a patent for $50,000. The legal life is 13, but we think the actual useful life is only 8, right? Don't mix those up. Useful life is different than legal life. When we calculate amortization, depreciation, we care about useful life, right? So 50 divided by 8, straight line, 6250 for the patent. Again, amortization, it's going to be straight line. You just kind of plug and chug with it there. It kind of builds off this, right? It says, oh, okay, we're doing that straight line, amortization, right? We're kind of plugging along here, and then we sell the assets, right? So it says the patent is $50,000, right? It's going to last 8 years, but after 5 years, right? So there's 8 years there, and then 5 years in, we sell the patent on there. So, hey, we sell it for 21, debit cash. We got to get the patent off the books. Credit patent, what it'll be is essentially the cost, right? What we paid minus the accumulated amortization, right? All of that amortization up until that 5-year mark, right? We got to get it up to where it needs to be. The difference here, right? It could be a gain or loss, but we're going to plug it here for a gain because it's a credit. Finally, a couple other things on here. So software development costs. So amortization of capitalized software development costs begins when the product is available for general release to the customers. The periodic amortization is the greater of percentage of revenue method or straight line method. So we talked about software development costs, right? We said you're going to expense until you hit technological feasibility, right? Thereafter, right, from technological feasibility, right, you're going to have, the next kind of stop sign is when it's available for sale, right? It's, we have like, it's out there, we're selling it. All of the costs in here, you're going to capitalize, right? And then afterward, once it's available for sale, right, all of these capitalized costs you amortize during this period, right? So development costs begin when the product is available for general sale. And you're going to pick, whenever you amortize it, the greater of the percentage of revenue or straight line method. Give it some numbers, it will help us make sense here. Right, so we have a corporation, they develop computer software graphics. It looks like a new project started in 2023. They reached technological feasibility on June 30th, 2024. Right, so tech feasibility here is going to be on what, 6/30/24. Okay. It says costs in 2024 were the following, right? So the first 6 months, the next 6 months, it looks like the software was available for sale on January 1st, 2025, right? So on 1/1/2025, on there, we are going to hold it available for sale. Okay, so we kind of have that second item in here. Then they tell us, once we held it for sale, right over here, here's some information, what we sold in 2025, what we expect to sell over the next few years. Okay, it says in 2024, Astro Corporation would expense the 1.2 in costs incurred prior to the establishment, right? So 1.2, these guys we expense, right, because they're before technological feasibility, and they would capitalize, right, the 800,000 over here, right? So the question becomes, right, we have this 800,000 that we capitalized. How do we now deal with this? Well, we said there's kind of two different ways that we can pick from. We're going to pick the percentage of revenue, or we have straight line. We want to pick the bigger of the two, right? So we have $800,000, right, that we capitalize, we got to account for. Let's look how we deal with this, right? So the first way is the percentage of revenue, right? We have $800,000. What we do here, right, is we're going to take essentially the current revenues, right? If we go back, 2025, right, what we did in the current year over what we expect in total, 10 million, right? So 3 over 10, 30%. Hey, there's $240,000. On the one prong, we calculated 240, right, for the percentage of revenue. On the other prong, right, we have the straight line method. If we look at this, right, it says the sales are going to incur over 4 years. So we'll basically take the 800,000 times, 1/4. We're looking at 200,000 for straight line. We got to pick the bigger of the two, right? 240, 200. There we go. That's the winner, right? 240. Hey, that's how we'll calculate debit amortization expense, credit, software development costs for 240. Then do be aware, right, that whenever you have intangible assets, they can have a finite life, right, right, where they last for like 5 years, 10 years, right? They're kind of captured. It's finite versus indefinite life. It doesn't mean they're going to last forever, but it just means that we can't really quantify it on there. So what are some examples with indefinite life intangible assets? The typical one's going to be goodwill, right? In these cases, right, whenever you have indefinite life assets, the idea with it is you're going to subject it to impairment testing, right? You're going to test it for impairment. In other words, do not amortize. So it's not like every single intangible ever you amortize. Most of them you do if they have a finite life. If they have an indefinite life, instead, right, you're going to test for impairment, okay? So again, don't worry about IFRS versus GAAP. And with that, right, we're going to end the lecture here. We'll pick it up. We're about halfway through the slides.